There's a guy I know, let's call him Marcus, who made $48,000 a year in 2018 and saved about $600 a month. Not impressive, but consistent. He drove a used Toyota Camry, lived in a one-bedroom apartment 20 minutes outside the city, and packed his lunch 4 days a week. By 2023, Marcus got a series of promotions. His salary hit $127,000. His savings rate? Down to $400 a month. He was earning $79,000 more per year and somehow saving $200 less. I'll give you a second to read that again. Here's the thing. Marcus didn't make bad decisions. He didn't gamble. He didn't blow money on crypto or start some doomed side business. He just did what every single personal finance article, every well-meaning HR packet, and every smiling financial advisor implicitly told him was the reward for working hard. He upgraded his life. And in doing so, he quietly, methodically, without ever realizing it, destroyed the wealth-building machine he'd been building since his mid-20s. I'm Susan, and I spend way too much time thinking about how most people are sleepwalking into financial disasters they could easily avoid. By the end of this video, you're going to understand the real math behind why high earners are often less financially secure than people who make half their income. We're going to break down the mechanism called lifestyle creep, not in the vague buzzword way you've heard before, but with actual dollar amounts. I'm going to show you why the moment you get a raise is statistically the most dangerous moment for your long-term financial health. And then I'm going to give you a specific framework, I call it the split raise protocol, for how to capture every salary increase without letting your cost structure cannibalize it. If you're someone who earns a decent income and still somehow feels like you're not getting ahead, subscribe and like this video. That's exactly who this is for. Think of your income as a pipe. Water flows through it every month, that's your paycheck. At one end of the pipe, money comes in. At the other end, money flows out into your life. Rent, food, car, subscriptions, dinners, clothes, vacations. The gap between the inflow and the outflow, that tiny space in the middle, that's your wealth-building capacity. Now, most people assume the way to build wealth is to widen the pipe, make more money, get promoted, get a second income. The pipe gets bigger and more water flows through. Problem solved. But here's what actually happens when you widen the pipe. The outflow end gets wider too. Not all at once, not dramatically, just gradually. A slightly nicer apartment, a car payment that didn't exist before, a gym membership that felt reasonable at this income level, dinner out on Thursdays because you've earned it. The pipe gets wider and the gap stays exactly the same, or shrinks. More water, same trickle reaching your wealth. That mechanism has a name. It's called lifestyle creep. And unlike most financial hazards, it doesn't feel like a mistake when it's happening. It feels like progress. Let's go back to 1985 for a second. A sociologist named Juliet Schor was studying American consumer behavior and noticed something that nobody in economics was paying attention to. As household incomes rose through the 1970s and early 1980s, the savings rate didn't rise with them. In fact, it went the other direction. In 1975, Americans saved about 17% of their disposable income. By 1985, a decade of meaningful real wage growth later, that number had dropped to 9%. By 2005, it hit 2.5%. Think about that arc. Americans were earning more than ever in history and saving less than ever in history simultaneously. Schor called this the cycle of work and spend. You earn more, you spend more. You need to earn more to fund the spending. You work harder, you earn more, you spend more. The loop never closes. What Schor found, and what nobody in the personal finance world was talking about at the time, is that spending doesn't just grow when income grows. Spending grows faster than income because spending is socially calibrated. We don't compare our spending to our past selves, we compare it to the people around us. And as your income rises, the people around you change. Your reference group upgrades, and you upgrade to match it. This is not weak willpower, this is not a character flaw, this is a fundamental feature of human social psychology. Your brain is a status tracking machine. It has been since before money existed, and it is working perfectly. It's just working against your net worth. Here's where the math gets punishing. Let's say you're 30 years old and you just got a promotion. Your salary goes from $70,000 to $95,000. That's a $25,000 raise. Beautiful. You pay your taxes. Let's say you're in a typical state and your effective rate, combined federal and state, lands around 28%, so your take-home increase is roughly $18,000 a year, $1,500 a month in extra cash hitting your account. Now, the standard lifestyle creep response. You upgrade your apartment, adding $600 to your rent. You buy a newer car, let's call it a 60-month loan on a $35,000 vehicle. That's $580 a month. You start eating out more, tipping more, spending more on clothes and experiences because you've arrived at a certain professional level. Add another $400 across those categories. Total lifestyle upgrade cost, $1,580 a month. You're earning $1,500 more, you're spending $1,580 more. You just took a $25,000 raise and turned it into an $80 a month deficit. That's not a metaphor, that is exactly what happened to Marcus.
Now let's run the other math. The math from the alternate universe where you don't do any of that. You take that same $25,000 raise, invest the entire after-tax amount, $1,500 a month, into a boring index fund returning a historical average of 9% annually. You are 30 years old. You do this for 30 years until you're 60. The result? $2,740,000. $2,740,000 from one raise that you invested and left alone. The lifestyle upgrade you actually made, the nicer apartment, the new car, the extra dinners, cost you $2.74 million. That's what the pipe gap is worth, not the apartment upgrade, not the car. $2.74 million sitting in an account that generates roughly $109,000 a year in passive income at the 4% rule. That's the true cost of lifestyle creep, and nobody puts that number on the lease agreement. Here's the part that makes this worse. Lifestyle creep is asymmetric. It's incredibly easy to upgrade your life and brutally hard to downgrade it. Psychologists call this hedonic adaptation. Your nervous system quickly adjusts to new comforts and treats them as the baseline. The $2,000 apartment that felt luxurious in month 1 is just your normal apartment by month 6. You don't experience it as a luxury anymore. You experience it as a requirement. So if your income ever drops, a layoff, a health crisis, a business failure, your fixed costs are now anchored to your peak income, not to what you can actually sustain. You're not just stuck living above your means, you're psychologically incapable of tolerating going back to where you were, because where you were now feels like deprivation, even though it was fine before. This is why high earners end up in bankruptcy courts. It's not the income that got them there, it's the cost structure that followed the income. Here's the escalation most people miss. The spending that lifestyle creep produces is overwhelmingly in fixed costs, not variable ones. This is the detail that destroys people. When you upgrade your rent from $1,200 to $1,900, that $700 is locked. It doesn't go away when your life gets complicated. It doesn't shrink if you have a bad month. You can stop going to expensive restaurants. You cannot stop paying rent. When you take on a car payment of $580 a month, that payment is due whether or not you use the car, whether or not you got a bonus this quarter, whether or not your kid just got sick and cost you $4,000 in medical bills you didn't plan for. Fixed costs are leverage working against you. Every dollar of unnecessary fixed cost you add to your life is a dollar that will hunt you down and demand payment, regardless of your circumstances. Variable spending, restaurants, subscriptions, clothes, is annoying to cut but cuttable. Fixed spending is a contract, and most people sign dozens of those contracts between age 28 and 35 without ever thinking of them that way. Here's who benefits from this, by the way, because somebody always does: the apartment complex industry, the auto industry, the financial services companies offering those low monthly payment loans. Their entire business model is premised on one thing: your income going up and your willingness to convert that income increase into a monthly payment instead of a lump sum investment. They are not accidentally structured this way. The 60-month auto loan did not become the industry standard because it was in your best interest. It became the standard because it allows manufacturers to sell a $45,000 truck to someone making $65,000 a year by hiding the real cost inside a number that sounds manageable: $740 a month. That's less than rent, right? Except it's $44,400 over the life of the loan on a vehicle that will be worth $18,000 when you pay it off. The math is right there. They're counting on you not running it. Picture this. You're sitting in a car dealership in 2026. The salesman slides a sheet across the desk. Monthly payment $699. He's smiling. You're smiling. Everyone in that room is smiling, except your future 60-year-old self, sitting somewhere, reading the difference between $2.74 million and zero, wondering what happened. The salesman didn't steal from you. He just offered you a transaction that made perfect sense right now and devastating sense over 30 years. That's the business model. That's why that room is always carpeted and it always smells like coffee. They are very good at making a 30-year consequence feel like a today decision. Let me show you two people. Meet Rachel and Derek. Same age, 32, same job, same company, same salary, $95,000. Rachel gets promoted in 2024 and receives a $20,000 raise. She follows the split raise protocol, I'll explain what that is in a second, and invests $1,000 of her after-tax monthly increase, allows herself $300 for lifestyle, and keeps the rest as a cash buffer. Derek gets the same raise. Derek upgrades his apartment by $500 a month, trades in his paid-off Honda for a $38,000 SUV at $620 a month, and starts ordering in more because he works hard and deserves it. Another $300 a month in food delivery. Derek isn't irresponsible. Derek is doing exactly what his friends, his colleagues, and his culture told him success looks like. Fast forward to 2044. Both are 52. Rachel has been consistently investing since her raise. Her index fund account is sitting at approximately $1,100,000, and that's just from the disciplined portion of one promotion. Derek has a nicer apartment and a series of cars he barely remembers. His net worth outside of a modest 401k contribution is $74,000. Same income, same job, 20 years, $1 million gap. The math isn't cruel. The math is indifferent. It just does what you tell it to do. Derek told it to fund his lifestyle. Rachel told it to fund her future. The math obeyed.
The emotional punchline here isn't the $1 million. It's that Derek, at 52, cannot afford to take risks at work. He can't say no to a bad project. He can't walk away from a toxic manager. He can't take 3 months off when his mother gets sick. His fixed costs own him. Rachel, at 52, has options. Real options, not I could theoretically downsize options. Actual, functioning freedom to make choices about her time. That is the real cost of lifestyle creep, not the missing million, the missing freedom. Here's your framework. I call it the split raise protocol, and it has 3 rules. The moment you receive any income increase, a raise, a bonus, a freelance windfall, anything, you split it before you touch it. Not after, before. You automate the split so you never have to rely on willpower. The first rule, the investment slice is always at least 50% of your after-tax income increase. Always, not sometimes, not when the market looks good, every single time. If your after-tax raise adds $800 a month, at least $400 goes to automated investment before you ever see it. Set up an auto transfer to a brokerage or Roth IRA the week you get the raise. Do not let it sit in your checking account and slowly get absorbed by existence.
The second rule, the lifestyle slice can be anything you want within a hard cap. The cap is 30% of your after-tax income increase, and it must go toward variable spending, not fixed costs. You can take the $240 a month and go to nicer restaurants, you can get a better gym, you can upgrade your vacation once a year, but you cannot use it to sign a new lease or take on a new monthly payment. Variable spending is reversible, fixed costs are not. The third rule, the remaining 20%, the buffer slice, goes into a high-yield savings account for exactly 12 months. After 12 months, if nothing unexpected came up, you can redirect it to investments. If something did come up, job disruption, health issue, emergency, you already handled it without touching your investments. This is the piece most financial advice skips. The buffer is what makes the other two rules psychologically sustainable. Without the buffer, one bad month forces you to liquidate investments at the worst possible time. With the buffer, you can stay the course through anything. Here are your 3 takeaways. 1. Your income going up is the most financially dangerous moment of your life if you're not ready for it, because every system around you is optimized to convert that income increase into a fixed cost before you can think. The car dealership, the apartment complex, the restaurant industry, they are ready. You need to be readier. 2. The real wealth gap in America isn't between people who earn different amounts. It's between people who have high fixed costs and people who have low fixed costs. Control your fixed cost floor, and you control your financial destiny regardless of what the market does. 3. Run your own numbers. Take your current income, calculate your savings rate as a percentage, then project what that savings rate compounded over 20 years actually produces. Most people have never done this. Most people are genuinely shocked when they do. The number either motivates you or terrifies you, but either way, it tells the truth. The system is rigged, but it's rigged in a predictable way. Once you understand that every income increase triggers a spending pressure campaign from industries that profit from your lifestyle expansion, and you decide in advance how to respond, you have already won. They are counting on you to make lifestyle decisions emotionally, in the moment, surrounded by social comparison and the relief of finally feeling like you've arrived. Don't. Make the decision in a spreadsheet, in a quiet room, before the raise hits your account. Lazy investing built more fortune than crypto memes. The people who retire early aren't the ones who earned the most. They're the ones who kept the gap between what they earned and what they spent and poured that gap into boring assets that compounded for decades while everyone else upgraded their apartments. And drop a comment. I want to know, when you got your last raise, what did you do with it?